Good afternoon, ladies and gentlemen. This short presentation would give Myanmar buyers of Olin and the traders of it on what CPO futures is and how to trade and the usage of it. See, in Bursa Malaysia derivatives, we have three types of derivatives. One is commodity derivatives, equity derivatives, and financial derivatives. What are derivatives? Derivatives are financial instruments to manage one's exposure in today's volatile market. The value depends upon and derived from underlying instruments such as commodities, interest rates, indices, and stocks. In Bursa Malaysia derivatives, for palm oil, we have the CPO futures contract, which is a crude palm oil futures contract, crude palm kernel oil futures, the USD denominated crude palm oil futures, and the options on the futures, CPO futures. What is futures? A futures contract is an agreement between two parties to buy or sell the underlying instrument at a specific time in the future for a specific price determined today. It can be physically delivered or it can be cash settled. The futures contract, CPO futures contract in BMD is a physical delivery contract, which means that crude palm oil can be delivered or taken delivery at the expiry of the contract. Later I'll be explaining to you about what is expiry of futures contract. A trader who has bought a futures contract can close out by selling the same number and type of futures contract he bought and vice versa. That means if he has shorted, that means he sells the futures contract first, he can also buy it and close the whole agreement. Functions of futures, as you can see, one, price discovery. The prices are established by interacting of demand and supply by the bids and offers of both buyers and sellers. Just like in the stock market, it works the same. Okay. Risk shifting allows the separation of risk, price change from risk arising from other normal businesses. Functions. Next, we have excellent hedging functions. There is a tremendous flexibility in the timing of purchases and sales, yet maintain anonymity. Market efficiency. It's a place where buyers and sellers can meet readily, and that reduces search costs if you do it by way of OTC, that means the physical side of it. Information benefits, it provides a facilitating, it provides a medium of place where it facilitates the flow of information, and that will be disseminated to the players. The advantages of futures. One, most importantly, is standardized. Standardized meaning that for every specific month contract has got a specific quantity, and that gives ease of transaction. Transferability, the sale can be offset by at any time between the date of original transaction and the date of delivery by buying the required number of contracts before maturity or expiration. Cost is very, very minimal compared to buying the real physical commodity itself. And most importantly, we have the credit worthiness. We have something called a clearing hub, which acts as a counterparty and handles the risk management side of transaction. It is also very liquid. It's easy to open and close position without causing significant change in price, unless if you are trading a huge number of futures contract, which also we have a trading facility called NLT that I'll explain to you later. Users of futures market fall into these two large categories. One, physical players, consists of refiners, plantation, importers, exporters, and merchants. The other side, from the financial side, we have bankers, fund managers, and some investors who like to take opportunity in profiting in the large movement of commodities prices. BMD CPO futures contract has been the global price benchmark for crude palm oil market since October 1980. The CPO is a deliverable contract which is traded electronically on Bursa Malaysia trading platform. It has got an impressive record of 30 years, and now it has become the reference point for all market players in the oil and fats industry. For CPO futures, as I said, that every futures contract has got its own standardized specification. For CPO contract, these are the contract specification. The underlying is called crude palm oil. The contract size is 25 metric tons. That means if you buy one contract of CPO futures, you are actually buying 25 metric tons of the underlying, which is crude palm oil. Minimum price fluctuation is 1 ringgit per metric ton. For trading, we have got first the spot month. Current spot month is July. June has expired. I'll let you know why June, how it goes later. So the spot month is July, and the next 5 succeeding months, and thereafter alternate months up to 24 months ahead. Trading hours, morning session 10:30 to 12:30. Second session is from 3 o'clock to 6 p.m. Every futures contract has got its price limits, because normally when you trade futures, you do not put in the actual value of the amount that you are actually buying. You put in a good faith deposit called a margin. So in order to mitigate the risk, every futures contract has got a price limit. For CPO futures, spot month has got no price limit, but the other months have got 10% above or below the settlement price of the preceding day. The most importantly here that you can see is the final trading day, the maturity date. Every futures contract expires on the 15th day of the delivery month, or if the 15th is a non-market day, the preceding business day. So that means, if you see, I told you that there's no June. June has already expired, because on 15th of June futures contract would expire. So right now is July. So 15th of July, the coming 15th of July is the expiry for the futures contract. Tender period is from the first business day to the 20th business day. What it means that if I'm holding a futures position, and as I said, CPO futures contract is a deliverable contract. That means if you are holding a futures contract, during the tender period, if you're holding a long position, that means if you are buying and you're holding a long position, you can be tendered to receive the crude palm oil in a port installation. This is the contract grade. As I said, that futures contracts are standardized. There's got a certain standard that you've got to follow. And if you can see, CPO of good merchantable quality in bulk, unbleached in pot tank, located at the option of the seller at Port Klang, Penang, and Pasir Gudang in Johor. Only 3 places. FFA is should not exceed more than 4% when it's delivered, and from the port tank, PTI should not exceed more than 5%. Moisture and impurities as such, and Dobie as written there. Okay, current initial margin is 6,000 per contract. As I said, this is a good faith deposit. If you are buying one contract, you need to have a minimum of 6,000 ringgit in your account. This is a small figure compared to the full value that you actually should have if you are buying 25 metric tons. At the price of say 2,350 ringgit per metric ton right now, for 25 metric ton you should have 58,750 ringgit. Yeah? So instead of putting a full amount of 58,750 ringgit, you can buy a futures contract. Your initial margin is 6,000 per contract, and the maintenance margin is 5,000. Since it's a good faith deposit, your account should have a minimum of 5,000 at the end of every day per contract. So if your balance in your account reduces below 5,000, you would need to top up your margin to 6,000 ringgit per contract if you are holding the position. Placing of orders with us, you can use 2 ways. One, internet orders. Another one is voice orders. Internet orders, once you have an account, as a broker, we'll give you an internet platform for you to key in your orders. You have the flexibility of executing it fast in the market. You can also check your own orders, amend, cancel, check your order status, and also your balance in the account. For voice orders, you can actually call us. We'll pick up the phone and we'll speak to you. And the advantages of doing voice orders is that we are there to assist you in your trading. And we can also give you the insights of the market. We have 2 facilities. One is NLT, another one is EFRP. NLT is used for large orders and is done off the market. So if there's 2 very big positions that a certain client wants to buy and another certain client wants to sell, we can do that off-market deal by using this facility. This actually minimizes possible price impact. EFRP refers to an arrangement between 2 parties whereby a futures contract is exchanged for related positions or vice versa. That can include cash, physical, swap or OTC derivatives. Okay, this chart shows a correlation between CPO and palm olein prices. As I understand, most of Myanmar buyers do import palm olein rather than CPO. They can actually use CPO futures contract to hedge price risk to a certain degree. Yeah? And next chart here, you can see the weekly prices since 1991. It's a continuous 3rd month CPO futures contract prices. Volatility of CPO prices has reduced compared to 2007 and 2012. As currently, the prices are in a narrow band between 2,200 to 2,500. This is actually the open position of futures contract since year 2010. to now. There was a collaboration between CME and Bursa Malaysia Derivative. Since then, the open position has tripled in the last 3.5 years, from 60,000 futures contract open position to 180,000 contracts. This gives actually good liquidity for physical players to hedge and trade. Next, this is the market demography since early this year. As you can see here, the average last 5 months, foreign institution in BMD account to about 40%. The domestic institution about 10%. Foreign retails 1%, and domestic retail about 17%, and locals. Locals are individuals who trade for their own account, and they operate from the company's premises. These are two examples of basic hedge that I'm going to talk about. Number one, we have got long hedge. A refiner who has to deliver about 10,000 metric tons of RBD palm oil, and when he faces a shortage of 2,000 metric tons of CPO to refine, and he's unable to find any seller in the bullish market, he would face a risk of higher prices. So he can turn into BMD and buy 80 CPO futures contract. Why 80? Because I told you earlier that every one futures contract is 25 metric tons. So for 2,000 metric tons, he would be required to buy 80 futures contract. So now, because he couldn't find CPO, he buys the futures contract, and this can effectively lock in his prices and reduce his upside price risk. So he waits for the tender process to take place and collect the physical delivery of crude palm oil. This is an example of long hedge. For short hedge, this I took the problem that sometimes Myanmar buyers face, where they buy the oil, and in the midst of delivery of the oil, they face a risk of falling prices. So what they can do is they can do a short hedge. So they, in June, say in June in this example, they purchase 1,000 metric tons of olein at 825 USD, and they're supposed to sell it in July. And if prices drop, they would lose money. So what they can do is they can come to futures contract and sell the August futures contract at 2,450 ringgit per metric ton. And the value of that contract is about 2.45 million. If the price drop in July from 825 USD to 780 for the olein prices, the merchant would lose a total of USD 45,000, as you can see in the calculation there. But in the futures contract, since he shorted at 2,450, shorting means is he would profit on the downside of the market. So in July, the prices drop, and as I told you that palm, olein and CPO has got a correlation. So in futures, he would profit about USD 48,400. So this eliminates the risk. Next, we come to how to actually open a futures trading account. For new applicants, for individual or corporate futures trading, they are required to review and complete the futures trading account form. There is something called a risk disclosure statement. It tells you about what are the risks involved in trading in futures and other required documents. Next, once they submit it to us, we will review and we will seek the approval. Once the approval is given, the client or the applicants trading number, and funding instructions. Next, the client have to just deposit the margin by using any of the 9 approved currencies. I will show you the approved currencies. And the last, start trading, as I said, by voice or by internet. These are the approved currencies for deposit. Australian dollars, British pound, euro, Hong Kong dollars, Japanese yen, Malaysian ringgit, renminbi, Singapore, and US dollars. These are only for initial margin, but for variation margin, say you are holding a position and you are having certain floating losses, that variation margin must be in Malaysian ringgit. So whatever deposit that you have for your initial margin, some of it may be converted into Malaysian ringgit for use of variation margin. You can, large corporations also can pledge pass-through letter of credit. This is through our clearing house as a form of margin collateral. In the event of clients default, which rarely happens, the pass-through letter of credit will be liquidated pursuant to a default action. The list of approved banks that you can get this facility can be found in the clearing circular of Bursa Malaysia Derivatives. These are my contact details. Please feel free to call me. Any queries regarding CPO futures contract. Thank you.